It looks like everybody is in. Thank you guys very much for taking the time to join us, especially if you were here yesterday. We really appreciate you coming back to see us again today. If this is your first one, welcome. My name is Kevin. I'm the head of business development at Kraken Futures. I'm joined today by Gary, who's our head of exchange operations. Gary, do you want to say hello?
Hey guys, thanks for joining us. Hope you find the session useful.
And so what we're going to talk about today is prices and margin. So we'll talk about the prices on futures contracts. We'll talk about liquidation and the different types of margin, and also importantly, how to avoid liquidation. And we'll do a few examples in the live demo platform as well. As we go through the session today, we've got about probably 15 minutes of actual content planned. We'll try to get you out the door in 30, but Gary and I will be around more or less as long as necessary to continue answering questions. So as we go through this, please ask questions. If you were here yesterday, hopefully you saw that we try to answer them more or less at the end of every slide or as they come up. So please ask questions and please try to engage. It is a really good time to get direct feedback and help. With that, I will leave this up for 1 second so our compliance team is happy. So why do we have different prices in futures in the first place? And it all starts with when you trade on spot markets. So when you trade on Kraken.com, you're exchanging one asset for another. So you're exchanging dollars for Bitcoin or euros for Bitcoin. You actually have dollars and you actually receive Bitcoin at the end. When you trade futures, and this applies to any crypto futures exchange, you're buying or selling contracts that reflect the spot price. So you're buying a contract that reflects the price of the asset. And the futures contracts, therefore, trade on a completely separate order book from spot. So there's no way to merge the spot and the futures order books. They are by definition separate. And because you're trading a contract that references a separate price, there are two moving pieces that you have to pay attention to in futures. There's the underlying spot price, the thing the contract references, and that's referred to as the mark index price, and we'll talk about that in detail. And there's the futures contract price itself. So that's the contract you're trading, and that's called the mark price. The mark index price is it's there to be the quote unquote fair price of the asset on the spot markets. So with futures, you're trading a contract that reflects the spot price. So it is actually critically important that you have an accurate spot price and that everybody trading on the platform agrees that that is the fair price of the asset. Everything in futures relies on a stable and robust index. So we can actually say with a high degree of confidence that we have the best index in the industry. And that's because our index is provided by CF Benchmarks, and we don't do it in-house so CF Benchmarks provides the index. And as evidence of that they are the best, the CME also chose CF Benchmarks to produce their Bitcoin index, the Bitcoin reference rate. So Kraken Futures and the CME use the same reference rate for our Bitcoin fixed maturity contracts. Basically, a stable index is the foundation for a stable futures exchange. Our index takes into account the real-time order book data from Kraken, Coinbase, Bitstamp, Gemini, and Itbit. And you can see it on the platform. We'll show it to you both in the live and demo platforms. It's here called Mark Index. So Mark Index on the platform under Market Details will always refer to the fair price of the asset at the time on spot markets. And this Mark Index price is important. It's used to calculate the perpetual futures contract funding rate. We'll talk an entire session about that tomorrow. And it's also used to bound the mark price. So during normal trading, the futures price, because it's a contract, can diverge from the spot price. So you need a mechanism to ensure that the futures price stays broadly in line with the spot price during normal trading. And that's what the mark index price does. The mid price. I think the next slide is actually this. Yeah. So the mark price is the mid price of the futures contract, but it is bounded by the spot index price. Basically, it's the mid price, but it can't go too far away from the spot price. The reason is the mid price, especially on spot markets, can be anything. It can go up or down based on market demand. The mark price is the mid price bounded by the spot price. It's important because it's used to value your open positions. It's also used to determine your liquidations. So the mark price is there. It will be the thing that is used to calculate your unrealized P&L. It's how you calculate your effective leverage. And importantly, the mark price is the price you pay attention to avoid being liquidated. Gary, do you have anything to add before we do a demo on the platform?
No, nothing to add.
I mean, if anybody has questions about it, please, this is a great time to chime in. If you have questions about mark price or index price, they are relatively new topics for most people. So let's have a look at what it looks like in our platform. So here we have the Kraken Futures live platform. We are going to go to market details tab right here. So we're on the Bitcoin perpetual contract, and the mark index price is here, 10,136. And the mark price, let's actually put it over here. It's much easier to read when it's vertical. You can close, by the way, with these, you can close all the tabs. So let's put market details here. It's much easier to read vertical. Mark index price is 10,133, and the mid price is 10,140, or the mark price is 10,140. So the futures contract is trading at a slight premium to the underlying spot market, a premium of 0.1% right now. If you put a trade on, you'll also see it referenced. So let's sign up. This is the demo platform now. This is your first time seeing it. You get a unique username automatically every time you click sign up. If you write this down, you can use it to log back in again. So we're going to complete the sign up. Let's just move a small amount of Bitcoin over. And we're going to put on, we're just going to buy, say, $1,000. We'll actually short it today. You'll see in the chart the mark price, and you'll see in the chart where you entered the trade. And I think that's, Gary, that's actually the mid price there, right? The blue one?
That's right, yeah.
Yeah. So let's talk a little bit about liquidations. You hear people talk about it a lot on Twitter. It's always like somebody's getting wrecked or something's getting, all-time high liquidations on BitMEX. Let's first talk about why we have liquidations as an industry in the first place. Talk about what it means, and then we'll talk about how to avoid it happening to you. So in traditional markets, when you trade on, it's gotten better, but especially in the past, when you traded with leverage, you were responsible for the full value of your trade. So if your position lost more money than the margin amount, you could go into what's called negative equity, which means you actually owe the firm more money than you put into deposit originally. And the firms would historically chase you for that money. And they could come after your real world assets. On Kraken Futures, there is no such thing as negative equity. In fact, the only funds you ever have at risk are funds that you have explicitly placed in your futures wallet. So returning to the platform here, I'll just show you quickly. Let's put up, yeah. So the funds in the Bitcoin holding wallet are never at risk. They can never be affected by trading activity on the platform. The funds in the futures wallet is your funds at risk. So that is margin for the trade, but you can never lose more than the amount in your futures wallet. So we don't have negative equity on Kraken Futures, and therefore we use liquidations as a way to make sure that people never go into negative equity. It protects the overall system, and it actually protects our users as well. So there's three terms that are involved with liquidation: initial margin, maintenance margin, and the liquidation price. Initial margin is the minimum amount of funds that you need to put in your futures wallet to make a given trade. So for smaller trade sizes, the initial margin is set at 2%. That's where the 50x leverage comes from. As the trade size goes up, the initial margin requirement will increase as well because there's more risk from your trade on the system. And you'll see this show up. So if you put in, say, $1,000 quantity, the buy margin required will be 2% of that. There's a little bit more because it's not sure if you're going to do a make or a taker trade, and the price might be slightly off from the mark price at the time. But the buy margin required will be 2% of your total amount, and sell margin as well. So your initial margin is the amount of money that you need to put in to enter that position. The maintenance margin is the minimum amount of funds required to keep the position open. So the maintenance margin will always be lower than the initial margin. The idea being that the trade should be able to go against you a little bit before you get liquidated. What does it mean, reduce only? Good question. So that's actually something we're going to be covering on Thursday in more detail. So it's a conditional order type. I'll show you how to do it in the demo now, but we'll be going through all of the conditional order types in more detail on Thursday. So just let's leave that one up there, and I can show it to you in the demo in a second. So when the maintenance margin is hit, your position will be liquidated. So when you've got 1% margin left in your trade, your position will be liquidated. So there are two things to keep in mind with these. Initial margin and maintenance margin use the mark price. And initial margin and maintenance margin are always in the underlying asset. So if you are trading Bitcoin, all that matters is the amount that's in your Bitcoin funding wallet, your futures wallet. If you're trading Ethereum, the only balance that matters is the Ethereum futures wallet. It doesn't matter if you have today have more Bitcoin and you can still get liquidated in Ethereum. I'm happy we had a question though. Please, other people, please chime in with questions as we're going. I know it's quite a lot of new content for people.
Sorry, Kevin, can I just add something else?
Yeah.
So if you go back to the page with the positions open, so you can see here we show a liquidation price. That is the price at which the value of your account will be lower than the maintenance margin. So while it's good to know what your maintenance margin requirement is, as that's the minimum amount of funds that need to keep the position open, there is the liquidation price, which will tell you in an easy way to understand that if the price, in this case, falls to that price, then you will be liquidated because your account value has fallen below that maintenance margin. And one other thing is, on the current contracts, the maintenance margin is always half the initial margin.
Yeah, it's actually just the next slide as well. So when the mark price hits your liquidation price, your position will be liquidated. So when your position is liquidated, it will be closed. Somebody's just asking if you can add maintenance margin before being liquidated, and that is the next slide. It's a great question, and we'll actually show you that. We'll actually show you that in the platform, so you can see exactly what that looks like. That's the next thing up. So when you are liquidated, your position will be closed. And you have to assume that your margin balance will go to zero. So when basically what happens is when the position hits the maintenance margin, the exchange takes responsibility for the position, both the notional risk as well as the remaining margin amount. Every exchange has its own way of handling liquidated positions. On Kraken Futures, we try to close out your position in the order book. And if we are able to close it out, you receive the proceeds of that trade. But we can't guarantee that it'll be able to close out so in the order book. So you have to assume it will go to zero, although in practice, sometimes you do receive some of the funds back. There are some questions now. If you increase your margin balance, will the liquidation price change in your favor? Absolutely, yes. And I think that's a nice segue to show a demo. Is it possible to change the leverage on an open position? Change it from 10x to 5x? Yes. And there's two ways to change the leverage on an open position. One is you can add more margin, and the other is you can reduce your position size. So if you remember the equation from yesterday, it was margin times leverage equals notional size. So if you want to reduce the leverage number, you can either increase the margin number or you can decrease the notional size number. And we'll show you, why don't we show you all three of those in the platform? Will we be sharing the presentations? Yes, we'll be putting these online. I know it's a lot of new information. It took me a long time to learn it as well. Please ask questions though. This is a really good, Gary runs the entire exchange. You're getting it straight from the source here. So a few people have referenced this in the last few seconds. There are three ways to avoid being liquidated. First, you could place a stop loss order that triggers before your liquidation price. This is a conditional order and we'll go into more detail on Thursday, but I can show you how to do it quickly today as well. You can also top up your margin balance, or you can reduce your position size. Remember, margin times leverage equals position size. So if your leverage is getting too high, like if it's getting closer and closer to 100, you can reduce your position or you can increase your margin. So why don't we use this as an opportunity to jump over to the demo platform. And we are going to just market close that position. So right now we've got $764 in our futures wallet. Gary, what do you think? Should we go long or short today?
Maybe a little short.
A little bit short. All right. So let's try to we're going to put on a highly leveraged trade. So let's try to do 20x leverage. The easiest way, the way I normally do it is I just take my available margin, 764, multiply it by, say, 20. So we're going to buy 15,200, call it $15,200 worth. So when we put this, we will do it as a market order just to make it faster. So what we can do here is we are going to sell short. And where is our liquidation price? 10.6. There's our liquidation price. So why is it done that? So here's, we've entered our trade. We're short. Our liquidation price is here. So if the price goes up to 10,608, our position will be closed. And right now we're trading with about 20x leverage. So there are three ways that we can adjust this. Let's say, for example, we want to decrease our position size. So that was one thing we can do. So I use the reduce only anytime I'm decreasing my position size. What reduce only does is it will only allow you to reduce your position size. It's really good if you're trying to close out, because and I've made this mistake myself, one of the mistakes you can do is accidentally sell. So we're position size of 15,200. If you're doing it quickly or you have a lot of positions open, you can actually accidentally sell too much. And what that will do is it'll create the opposite position open. So if you only ever want it to go to 0 and not beyond into positive territory, use reduce only. Reduce only will ensure that you're only reducing your position exposure.
Yeah, Kevin, so if you try to short further, you'll see it get rejected. So if you...
yes, would not reduce the position.
Yeah.
So if we're going to do, so let's go call it 2,000. So we're going to reduce our position size by 2,000. We are short right now. So to reduce the position, we need to go long. We need to do the opposite. And what you're going to see is the liquidation price will go up. And there. And if we do it again, you can see it go up even further. So each time you reduce your position size, you're lowering your leverage and your liquidation price goes back up. We can make it go down by increasing our position size as well. The other way you can make the liquidation price move further away from the liquidation price is by adding more margin. So here we've got our holding wallet. These funds are not at risk in this trade. And we've got our futures wallet. These are the funds. This $428 is funds at risk. If we're getting closer to our liquidation price, we can always just go in and add a little bit more. I'll just pick an arbitrary amount. And what you're going to see after I click this is the liquidation price will go up. Because margin times leverage equals notional value. So if we increase the margin, which we just did, the leverage will go down because the notional value stays the same. Can you add, so I think, is your max loss equal to initial margin plus maintenance margin? Your max loss is equal to the initial margin. Is that correct, Gary?
Well, it's actually equal to whatever funds are in your margin account. So even though the initial margin is the minimum amount you need to open a position. So as Kevin mentioned, in most cases for smaller positions, it's 2%. But if you say open a position at 5x, so you have 10 times more in your margin account than the initial margin, all of those funds are at risk with a position. So the liquidation price will be higher or lower, will be further away. But once you hit that liquidation price, the whole amount that was in that margin account will be lost.
The person that asked that question, please let us know if you'd like more clarification on it. So can you add more maintenance margin before being liquidated? Hopefully we've demonstrated that. And you can also conversely remove margin if you want to if you want to get more leverage. So in this example, let's move some money back out of our futures wallet, and what you'll see is the liquidation price will drop. So we're going to move money from futures wallet, and let's move this amount, and watch as the liquidation price drops. Because we've taken margin away, which increases our leverage. If I'm limited to 2x leverage as a retail investor, how I get change access to 50x? Gary, do you want to handle that one?
Yeah, you'd need to submit a ticket, and then our support team will be able to help you and whether you would qualify to take the 50x. I think there was also a question about if the price very briefly dips below the liquidation, is the position always liquidated? Yes. So the whole system relies on that mechanism of as soon as the value of the account falls below the maintenance margin, so when the liquidation price is hit, we have to close out positions, and that happens automatically. Right,
but Gary, it's the mark price, not the last trade price.
Exactly, yeah. So that's kind of comes back to what Kevin started with about the mark price. So the mid price can, in theory, go anywhere, but the mark price, which is used for liquidations, helps to bind that price to the index price. So the underlying spot asset, so it can't deviate too far away from that underlying spot asset. So someone can't come into a low liquidity contract and try and move the price to try and liquidate people, because the underlying spot price would have to move with it.
If you increase the margin balance before the liquidation price, will it change in your favor? Yes. The liquidation price will move further away from mid if you increase your margin balance. I can actually, if you give me 1 second, show you that. So I'm just on my phone just for fun. I'm about to put in on the demo website a very large buy order. And what you'll see is that it won't move the mark price because it'll just be a single trade. So this trade shouldn't be liquidated, right, Gary? If I just put in a
yeah. It shouldn't be liquidated.
So let's do market. Please bear with me for 1 second. Let's keep. I'm just going to make it closer and closer so that I can more easily adjust the price. And this is the kind of stuff you can do on the demo platform to test. I would recommend you do it. So let's go. And now I'm going to go long. And what you're going to see a huge wick go up in a second here. I think. Sorry, please bear with me. There. So that wick, that was me. You saw this huge buy and there's a big wick. So the price very briefly went above the liquidation price, but because the mark price didn't move, it didn't affect your liquidation.
Yeah, so show the market previews tab. Sorry, the market details tab. I'm not sure if you've got that open.
Yes, let me open it here.
Yeah, so we see the mark price didn't change. Obviously, we don't have the history of it, but it didn't go up with the mid price. So that's why it wasn't liquidated.
The other thing that you can do, and we're going to do this in more detail on Thursday, is you can put in a stop loss order. Gary, I think maybe let's save that one for Thursday if it's okay.
Yeah. I think there was a question on how big of a percentage of 50x leverage trades usually gets liquidated. I guess it depends. Basically, any 50x trade, any move more than 1% will liquidate that position, basically. So it's best to think about it in terms of price moves. Is there a manual that explains the platform? So we have support articles. I think Connor's just sent out a link to the interface guide. Hopefully that should cover most of these things.
And the other thing that we've got is we've got the video series, and we're also in the process of adding tooltips to everything on the platform. So there will be, and very soon, like explanations of what everything means throughout the platform. That's in the next couple of weeks, right, Gary?
Yep. Are there any perpetuals? No, we also have futures of maturities. So we have monthly and a quarterly for each USD pair.
Yeah, so they will all trade independently. I just use the perpetuals because it's the easiest one to understand.
Yeah, perpetual has sort of 80% of the volume across all futures platforms. You did several trades in the demo. Where can you see your P&L for these trades? So you can see the P&L on this open positions for the current open positions. If you want to see it for closed or individual trades, can you go to the logs, Kevin?
Yeah,
That's on the left-hand side. Yeah. So you can see here the realized P&L. Obviously, they're quite small. If you download the CSV, you'd be able to see the actual amount, but this is kind of rounded up. You would see the P&L of each individual execution here if you were closing a position.
Close. Yeah, now you'll be able to see it there.
Yeah, there you go.
How are the fees calculated on futures contracts? Sometimes when I do quick scalping trades, I don't actually get what the P&L indicates unless I hold the position longer. That's when I get close to P&L.
So I think something to consider is because the mark price might not equal the mid price. So if you show an unrealized P&L on an open position, you may not actually be able to get out of that price. Exactly, because there might be a slight deviation between the mark price, which values the position, and between the mid price at which you can actually get out. So if we look now, Kevin, do you want to open the order book?
Yep. Should I use the regular order book or the?
This is fine as well as an example. So if you look here, we can see the mark price is 10,194. So if Kevin wanted to close this short, you would have to buy slightly higher than that.
I wanted to close it, so it's
yeah. So if you look at your logs, you'll see what price you actually get executed at. There's multiple trades there, but so some of it was at 10,196, some was at 10,94, but the mark price was at 10,191. So you got a slightly worse price than the mark price for some of those trades. So that's something to take into account when you're trying to do I guess quick scalping trades, is it might look like it's a P&L compared to the mark price, but you might get a slightly different price you get executed at. And in terms of fees, if you're a taker, so if you're aggressing into the order book and taking liquidity, i.e. like a market order, then you will pay 7.5 basis points based on the notional value. And if you are a maker, so you're providing liquidity, so you queue an order, so you place an order, it sits in the order book, and then someone else executes against it, then you would receive 2 basis points rebate.
So again, we're gonna cover those in more detail on Thursday. So we'll show you examples of maker orders and taker orders, and we can explain the fees exactly as we go through. Sorry, Gary, please go.
No, that's fine. I was done.
Yeah, go ahead.
What would your best advice use to reduce your risk in futures trading? I guess it depends on what you're trying to do, but I guess not be over leveraged is the obvious one. Give yourself more room so that if there is a move, you can react and either add more funds, reduce the position, or close it yourself. But again, it depends totally on what you're trying to get out of it and what your strategy is.
And speaking personally, just generally trade with less leverage than you think you need. Is it possible to change leverage position? I think that's an older question. I think we've already covered that.
Yeah, I can't see any new ones at the moment.
Great. So please do keep asking questions. We'll be around as long as you'd like, but I also want to be respectful of everyone's time. So in conclusion, the mark index price is the fair price of the asset in the spot markets. It's based on the price of the trading across multiple exchanges in real time. The mark price and the mid price of the futures contract. The mark price is the mid price of the futures contract bounded by the index price. So for all intents and purposes, the mark price will be the mid price of the futures contract. It's only if it skews too far out of line that it'll get bounded. The purpose of liquidations is to prevent clients from having negative equity. That protects our clients, and it also protects the sort of overall stability of the exchange. The initial margin is the minimum amount of money that you need to open a position. It's 2% for if you're trading with up to 50x leverage on smaller trade sizes. And the maintenance margin is the minimum amount you need to keep your position open. So it'll be half of the initial margin. So it's 1%. And the way you keep track of the maintenance margin is based on the liquidation price. So it'll always be clearly posted in the chart what your liquidation price is, and you'll always see it. You'll always see it in the details tab. When the mark price hits your liquidation price, your position will be liquidated. And there are 3 ways to avoid liquidation. You can add more margin, you can reduce your position size, or you can use a stop loss trade, which we will do in more detail on Thursday.
We've got another question, Kevin.
Oh, cool.
So does the market index price protect traders from stop loss hunters, as in a single whale cannot move the price on the Kraken Futures price single-handedly because of this index? Yes. So as Kevin demonstrated with the liquidation on the demo, as he moved that price up, the position wasn't liquidated because the underlying spot index didn't follow it. In terms of stop losses, we'll obviously cover this in more detail on I think it's the next session or the session on Thursday. But when you place a stop order, you can choose to use the mark price as your trigger, so it would work the same as liquidations. So again, if someone tries to move the price up, you would only get the stop loss triggered if the the index follows that price as well.
Can we see in our profile which address is on file? Yeah, I guess if you email me that you'd like, just email me the question, and I'll send you like the street name or something. Yeah, we can do it as a one-off. I want to ask about flash movements in price in the spot market. If the price goes up or down by 500 on the spot market for Bitcoin, for instance, there's a flash movement and immediately returns to where it was, will the futures contract price be affected? That is a really cool question, and that goes back to our point about why the quality of the index that you use is the most important thing. And a good example of that working incorrectly is there was a flash crash on Bitstamp about last summer, I think, where a whale went in and just like market sold, I think, several $1 million. It wasn't market manipulation. Turns out it was actually just a guy selling Bitcoin. But some guy went in and sold millions of dollars worth of Bitcoin in one shot, and it crashed the price of the book in Bitstamp. It also had an effect, and Gary, correct me if I'm wrong, of crashing the price on the BitMEX index as well, because they just use the Bitstamp price as one of their input exchanges. It did not affect the price on our exchange because our index is robust and it's able to withstand what could be market manipulation or fat finger trades. In that case, that's what's called a fat finger trade. So Gary, please correct me if I'm wrong or add in there. Yeah,
exactly. So that's why we use the 5 constituent exchanges that Kevin mentioned: the Coinbase, Bitstamp, Kraken, Gemini, and Itbit. And there's certain things that the index provider does that if one exchange deviates, the whole index won't follow it. To make sure that just because something happens on one exchange doesn't mean it affects the futures price.
Yeah, and we're really proud. It's not the sexiest part of the business, but we're very, very proud of the index that we use because we think it keeps our traders safer, and we know it's robust and tested. There's a question here. Your male K index, your market index, does it take into account BitMEX or FEMEX spot price action? I'm sorry, to the person that's asking that question, could you please retype the question? Gary, maybe you can understand it. I'm having a bit of trouble.
I think it's asking if we take it, if not taking into account BitMEX or FEMEX spot price is a good thing or a bad thing. I guess, well, I mean, I guess the BitMEX, taking BitMEX into account, I don't think necessarily makes sense. I think you would take into account the price of the underlying, so the value of the underlying asset. When it's traded on a spot exchange, and the index team, the index provider is always adding more exchanges to that meet their criteria. So they're very strict criteria of which exchanges can be in an index. To keep it as robust as possible. I'm not too familiar with FEMEX, but I know that they're always adding new exchanges whenever they can to add to the robustness, I guess.
We're happy to stick around, but for those of you still here, we'd love for you to join us tomorrow. We're getting more technical as the week goes, so we're going to talk about contract details. We'll talk about what the funding rate is, and this is, I think, one of the hardest concepts in futures trading, and one of the least or most poorly understood concepts. So we'll talk about that in detail. We'll talk about what basis is. We'll talk about volume, open interest, and maturity, and some of the misconceptions around that. And then on Thursday, we're going to talk about trading futures in more detail. So we'll go through the order book. We'll put on market and limit orders, like live examples, and explain all the parts of it. We'll put on conditional orders, and we'll do order options. So things like reduce only and maker only. So hopefully by the end of the week, you've had a chance to see a pretty good tour of the platform and ask as many questions as you'd like. Thank you so much for your time today. We really appreciate it. And we hope you'll continue forward with us the rest of this week. Thank you.